Welcome back to the Old Fashioned Real Estate Show. My name is Jeff Holst, and that
Brian Leverage.
Correct. And in this episode, we're going to talk about one of my favorite topics, one that I've been talking about for years now, but one that we haven't ever covered before, and that is why I personally, and I think that guy does too, loves mid-size multifamily investments. So we're talking about apartment complexes between like 10 and 50 units, and we're going to do it right after this.
Welcome to the Old Fashioned Real Estate Show, where hosts Brian Leverage and Jeffrey Holst for our old fashioned real estate advice.
All right, Brian, so what do you think? Do you buy apartments?
Yes, I buy apartments. I actually like a lot of assets in that, well, we didn't even say the price range.
We did not.
We just said the unit count. Oops.
Yeah, that's true. It must be all that water you're drinking.
Yeah. Making me crazy.
You know, if you drink too much water, you drown.
Yeah.
Just thought I'd share that with you.
So thank you, Mr. Wizard. And
So anyway, so I think where Brian's going is one of the things that I personally like about mid-sized multifamily is that there's less competition. And I think the reason for the fact that there's less competition is that once you get over about $1 million loan balance, you kind of scare away the average real estate investor. You know, the people that are buying duplexes, they just don't want to buy the 10, 12 unit buildings that cost 1.2 million bucks. Because it's kind of scary. And it was for me. I don't know how it was for you, but the first time, I mean, it was exciting, but the first time I signed a loan with $1 million balance, I was like,
God, I hope this goes right.
Yeah, because that can hurt, right? So it does scare people away. So there's a little bit less competition from the lower side of the market. And if you stay under about $5 million, you kind of stay away from the big syndicators and the hedge funds and stuff like that because the deals are just too small for them to properly scale. So it's kind of a sweet spot in the market between the two. And honestly, most of your big real estate investors did start with 10, 20, 30 unit buildings. I mean, Brandon Turner talks all the time about his first apartment building, which was a 24 unit building. I don't know what he paid for it, but I'm guessing it was more than a couple bucks and less than a few million.
Mm-hmm. Yeah. So it's too big for mom and dad.
Yep.
Too small for the deep pockets, the institutional investors. So it creates that nice sweet spot. You know, the other thing too is, you know, in addition to the price tag, usually there's a fair amount of work that goes into these things.
Yeah, and it is difficult. So like there are objections to it. A lot of people have told me like we had Ben Leibovich on our show, and he was adamant about how he would never buy in that price. I mean, he used to, but he doesn't anymore because he thinks it's too hard to scale, right? And because it is a lot of work.
And there is some truth in that.
Yeah, and the way that we've solved that, at least the way I think that we've solved it, is we buy in a sort of smaller area, right? Like we confine ourselves geographically to an area that allows us to scale without scaling in a single property. I mean, if you buy a 100-unit building, you have 100 units on the same address, right? But if you buy five 20-unit buildings within a half mile of each other, you kind of have done the same thing. And the thing about the 20-unit buildings is a lot of times the owners have had them for 15 or 20 years, and especially in a rising rent environment like we've seen now, they may have raised rents for the whole time, 2-3% a year, and it was just their policy to always own them. In fact, I bought a building a couple of years ago where the guy, it's the only apartment building he owned, right? He owned one apartment building, and he always raised the rents 2 or 3%. In fact,
sometimes they don't raise them at all, though.
Yeah, exactly. But I mean, I remember distinctly sitting at the closing table with this guy, and rents were like $500 or $600 per unit on this property at the time I bought it. And he was like, "You're going to do really well on this. I've been able to raise my rents 2 to 3% every year," right? And I'm looking at him and going, your rents are like 30% below market. Like I don't even have to fix it up to raise the rents 30%. Because rents had gone up for 10 or 12% for 2 or 3 years in a row, he just hadn't kept up, and it created an opportunity. And a lot of times those people get tired and they don't fix the property up as well as they should. And that's really what Brian and I have done with a lot of our properties, as we've come in and taken C-class buildings and turned them into B-class buildings.
You know, the other thing too, and this is true with all apartments generally, is that, you know, viewed generally within real estate as the stablest asset class to own.
Yeah.
Right? Because in a worst case scenario, we're seeing this, I don't want to diverge too much, but like in commercial, right? Like, are we going to start to see office vacancy rates skyrocket? It's already kind of happening, right? So if you own commercial in the downtown core in any mid-sized metro area or larger in the US, you've got some potential risk factors there. But at the end of the day, everybody still needs a place to live, right? Even if they can work remotely, they've still got to do that from home, right? So if they're not going to Starbucks or the library.
Yeah, and I mean, there's, but they still have to live somewhere, even if they go to the library to work. There is an argument to say that if people can work fully remotely, they might choose to do it from the beach, like in Puerto Rico, like I do.
Yes.
Or from some other exotic location.
Well, we were talking about people that actually work.
Oh, fair, yeah, fair point. But there is an argument for that, and then I would direct us back to when we had Ian Pearson, the futurologist, on our show, where he said, like, buy pretty places. They're not making more pretty places, and that's like, honestly, in a way, that's kind of one of my things. But my pushback to him would be, and if you're watching this, Ian, I'm going to tell you this to your face. Is that they're also not making any more apartments. I mean, they are building some, but they're not building apartments at the rate of population growth. They have not for a couple of years, almost a decade now, and it's created a shortage. And then during COVID, they stopped almost all new construction for a while, and then supply chain slowed the process down. So we've gotten an even bigger shortage of housing.
Well, and then just to add to that, right, the new construction apartments that are coming into the supply chain are, by virtue of those same costs, much more expensive.
I mean, there's a difference between renting a $2,500 a month downtown apartment and a $900 a month suburban apartment.
Right.
And a lot of people say, I'm going to build like lower price build to rent, but with inflation, that's not possible. Like, you can't build an apartment and rent it for $900. Like, there's no way that math's ever working.
Not unless somebody donates all the construction materials. Right.
Or the land.
Realistically,
like unless you don't care about a return, you can't.
Non-unicorn land, that's not going to happen.
Yeah. So another thing I really like about mid-sized apartments, but apartments in general, is that they're commercially rated. So that means that they're valued based on the income approach. Mm-hmm. And we've done whole shows on this when we talked about cap rates and raising your NOI, and we talked about some ways you can raise your NOI. But the short version is, if you buy a duplex, right, or a single family house, and your neighbor sells his house for $100,000 less than you bought your house for, your house went down $100,000. Because if it's a similar house in a similar street, in a similar condition, and it's $100,000 less, yours is $100,000 less. But if I buy a 10-unit building, and Brian buys a 10-unit building, and then he decides to sell his really cheap, it doesn't matter to me, because as long as my income is stable, my value is stable.
Yeah.
Now, obviously, there's this cap rates can compress or they can go up over time. But we haven't seen significant changes in cap rates. And actually, from pure economic theory, that makes sense, because cap rates are like the entirety of the market's idea of what they're willing to accept as a return on dollars. Now, in a rising interest rate environment like we are, you would expect to see cap rates go up. But what we've seen and said, at least so far, is cap rate compression has stopped. Cap rates were going down, and now they're just kind of chilling.
Yeah.
And they maybe go up a little bit, but they have gone up a quarter point at the most.
And tangentially to that is I see a lot of industrial properties on a weekly basis get emailed to me, and this is nationally, mind you. And on apartments, I generally only look at things regionally, so it's not an apples to apples comparison. But interestingly enough, a lot of the industrial properties that have come out, I felt priced at either too low a cap, right, meaning the price is too high. They've come back out at lower prices, right, trying to retrade them to get them to sell. And I have not seen that happen in apartments. They've, held their line. Mostly the owners are, they're probably, as we were, they bought well, so they don't have to sell. They've got good financing in place, et cetera. So absent some kind of maybe not extreme circumstances, but unique circumstances, people are positioned to ride it out, and you're just not seeing a lot of great buying opportunities.
And this comes back to something I said on a previous episode, but like, if you have long-term debt in place and you have cash flow, it's pretty hard to lose that property.
Yeah.
right? I mean, like, this is why during the last recession, when the foreclosure rate was skyrocketing, and just to be clear, when I say the single family foreclosure rate was skyrocketing, it was still single digits. It was just higher single digits. But the mid-size multifamily foreclosure rate was less than 1%, significantly less, like a tenth or a little bit more than a tenth of a percent foreclosure rate. And I think the reason for that is you're dealing with, one, more sophisticated buyers, right? But two, the values are less subject to radical price swings. The reason we've seen prices go up so much in the last few years is because income has gone up. Rents have gone up relative to the increases in expenses, which has increased NOI, which has increased the return, which means the property is more valuable. And one of the things that people forget, and like I said, we did an episode on cap rates before, but cap rates are an inverse relationship. The lower the cap rate, the higher the value of the property. And so, we're looking at least in our market, 7% cap rates, maybe a little bit less, maybe a little bit more, but I mean, in that range for like B-class properties, the kind of properties that we're talking about, which means that if you increase the income by $1, per year, you're actually increasing it by the inverse of 7%, which is going to be like $14 in equity by having $1 more income. And so when you know that relationship, it's like, it's an amazing way to create forced appreciation, that's really the name of the game. You can build the equity quickly. You can refinance if you're in a lower interest rate environment than we are now, and you can walk away with all of your money back or more and still own the property.
Yeah. Is there anything else we want to add, or?
Yeah, get out there, buy mid-sized multifamilies, but not in Chattanooga because there's no deals here. No. Or maybe because we took them all. Yeah, let's go with that.
Well, we hope that helped nonetheless, even with the warning at the end. We appreciate you joining us, and we'll see you again soon.